The second phase of the housing market has officially started. I've been saying it for a while now that November will be the month that we start to get the very first signals that the housing crash is starting to pick back up again, and that's exactly what's happening right now. We're starting to see prices start to decline again and pick up from where they left off. Now, we still have a long way to go until we reach the bottom of this housing market correction, and builders see that. They see what's taking place, they see the writing on the wall, and they're having to make massive adjustments on their part. They're going to be playing a massive role in this housing correction too, which I'll talk about in today's video. But before I start getting into this, there's a lot to talk about today. We got all of that I just mentioned. We got inflation data that just came back. So much to go over in today's video. But before I get started, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe. Hit that notification bell to watch more content like this. And with that said, let's jump into it. House prices are finally starting to fall again. Now, over the past several weeks, house prices have basically been at a standstill. But like I mentioned on this channel many times before, the median sales price is a very delayed metric. Essentially, the homes that were closing in September and October were homes that hit the market back in July and August. And it takes around 30 to 45 days just on average for homes to close. Well, during that period of time between July and August, mortgage rates were actually hovering around the 5% levels, which is much more affordable than where they've been at these past couple of months. Now, naturally, when we drop down to these 5% levels from around the mid 6s in June, that caused home prices to temporarily stagnate and stop their decline. Now, when we got to September, we saw those mortgage rates shoot up again, reach those new highs in those 7% range, and that caused us to get to the point in the housing market where we're at the most unaffordable housing market in over 38 years. Now, the highest we've gone so far is about 7.37%. Now, although we're currently sitting around the high 6s, for about the last month and a half, we've been mostly hovering around the 7% range. So as affordability has been plummeting, and I mentioned this in my videos back in September and October, that we will not see this level of mortgage rates have an effect on home prices until really the November data starts coming back, because again, like we said, the median sales price is a very delayed metric. Well, according to early November data that we got from Redfin, which Redfin provides some of the most up-to-date information for those who are curious, well, we're seeing that across the country right now that we're starting to see price declines of home prices continue to pick up from where they left off. Essentially, these prices are finally starting to catch up to these mortgage rates like I talked about, and essentially what we're going to see is that as these homes sell, they're going to create new comparables that will affect the price that the next seller is going to list their home at. Just 2 weeks ago, Redfin was showing the median sales price at around $364,000, which is where it was hovering around for about the last month or so. Well, now we've taken a drop in just the last 2 weeks from $364,000 down to $359,000, which is about a 1.4% drop in price in just a 2-week period. So at this point where we stand nationwide, we're already seeing that prices have come down 8.4% from peak levels. Again, that's a nationwide number, as some markets are already close to what we would call a housing crash. Housing crash, technically speaking, would be about a 20% drop or greater, and there are already some markets that are approaching that point. For instance, Austin, Texas is already down 17.8% from peak levels. You have San Jose also down 16.1% from peak levels, and then you have Seattle, Washington down over 11.4%. Now, as we're looking into this second phase of the housing market correction, we have to take a good look at what's going on with builders, iBuyers, and investors, because they're going to play a major role in this. You see, right now, your typical homeowner doesn't really have a lot of incentive to sell their house, especially if they're locked into an ultra-low mortgage rate. So what that does is, even though buying demand is going down drastically right now, we're still seeing the amount of active inventory, the amount of homes that are currently on the market, also continue to go down as well. So essentially, supply and demand are both shrinking at the same time. But what I think that ultimately will give buyers the edge in this battle going on between buyers and sellers is that iBuyers, builders, and investors have a need to sell. Particularly builders and iBuyers have a lot of inventory that they need to offload, and the longer that they hold on to it, the more that prices will decline, which means bigger loss losses on the way for them. In addition to that, they have to deal with holding costs such as property taxes, insurances, any financing costs. And so basically they need to offload their inventory ASAP before things start to get out of control with their losses. Now, builder sentiment just came back for November, and it's part of the builder's job to look ahead into what the future holds for the economy and the housing market, because ultimately that's going to have a huge effect on their ability to sell their houses. Well, last month in October, builder sentiment was at a 38 rating. This month, the expectation was for it to hit a 36 rating, but in actuality, we saw a rating of 33 for the month of November. Now, to put it in perspective, anything above a 50 rating is considered a positive outlook on the market, whereas anything below a 50 is considered a negative sentiment. So when we saw a rating of 33, that was actually the worst rating we've seen since June of 2012, not counting a quick blip we saw at the beginning of the pandemic. So what do you think builders are going to want to do if they believe the future of the housing market looks like it's going to get worse from this point on? Well, they're going to do everything they can to offload their inventory, up their incentives, slash their prices more, whatever they got to do, because whatever it is today, this market, it's only going to get worse from this point. So it's in their best interest to offload their inventory as fast as possible. Now, I wanted to get some more insight into what's going on with the builders, and Rick Palacios of John Burns Real Estate Consulting actually did a survey with builders across the country, and this is what he found. This is what he had to say. He said, home builder commentary from our survey this month was about as negative as I've seen to date. Here's some of the market color that jumped out. So he's talking about some quotes that he received from different builders across the country. Biggest challenge is your customers who just close their home and see you drop prices by $30,000. Buying land at the top of the market and having to pull every incentive lever to sell is not a recipe for success. We'll cut starts 60 to 70% in 2023. Boston Builder said October was exceptionally weak. Harrisburg Builder said October was the worst sales month in 12 years. No buyers, no sales. Baltimore Builder, the market is terrible. Birmingham Builder, the market is weakening demonstrably. So you can see the negative sentiment that's going around the country. Wilmington Builder, the market is falling off a cliff. Phoenix Builder, October started strong. Then there was a head fake, and in the last 2 weeks, things dramatically worsened. So builders are clearly feeling the pressure right now. They're upping their incentives, they're slashing their prices, and every time they do that, once they sell a home, it becomes a new comparable on the market that affects the sales price of future homes that get on the market. So if you're a regular home seller with an existing home and the new construction down the street cut their price by $100,000, that sales price is going to drastically affect the price that you can sell your home for. Now, the reason why this is a much bigger deal than many people realize is that new construction, this was reported by Redfin, that new construction is making up over 29% of all home sales. This is according to the third quarter sales report. And so that means that 29% of the homes sold are having to deal with these massive price cuts, these massive incentives, anything they can do to offload the inventory. So naturally, when they do that, of course, that means there's a huge portion of the market that is really going to have a huge effect on the resale price of these other homes, these average typical homeowners who may not want to budge on their price, but too bad because the new construction, 29% of the market is actually doing that. Now, Ibuyers are dealing with existing homes, and they're also causing problems with this as well, as they are operating at major losses in many cities across the country, and they also need to offload their inventory as well. You can see in this chart the current asking price versus what they purchased the house for, and in many markets they're seeing a massive loss even at this point in the market. So you look at markets like Phoenix, they're already down 10% in what their current asking price is versus what they purchased the house for. They're also slashing their prices by 2% on a bi-weekly basis. So again, all of this is going to contribute to lower comparables affecting the sales of your average typical homeowner. And finally, you have many investors that carry financing on the fix and flips they do. You talk about hard money loans, you talk about private money loans, and eventually those loans have to mature. Typically, it lasts about a year or so. And so that forces them to need to sell now because again, they're smart, they're looking ahead, and they know that the future outlook of the housing market looks pretty gloomy. gloomy, so they need to sell sooner than later as well. Again, more forced sellers pushing down prices. Now, taking a step back and looking at the big picture, we recently got inflation data back, which for the month of September, we were at an inflation rate of 8.2% year over year. In October, we were expecting it to come back at 8%, but it ended up coming back at 7.7%, which was a nice surprise. Now, even core inflation came back better than expected. We were looking at 6.6% levels in September. We were expecting 6.5% in October. Came back at 6.3% actually, which was even better. And the Fed pays very close attention to core inflation, which for those who don't know, core inflation is just your inflation, not counting your food or energy. So this news essentially led to stocks rallying. We saw treasury bond yields start to fall, which ultimately that's what led to mortgage rates declining to where they're at now in the high sixes. So what this means for the housing market ultimately is if inflation can be easier to get under control than we originally anticipated, then we may have seen the peak in mortgage rates at this point, which in that case, if that is true and that we've seen the true peak in mortgage rates, then that's going to limit the downside of what we're going to see in house price declines. So we'll have to keep an eye on what inflation continues to do, as it does play a huge role in the housing market as a whole. But regardless, we're continuing to head towards an economic recession at this point. We're hearing more news about more layoffs taking place, especially in the tech sector. Amazon, for one, just announced it's going to eliminate 10,000 jobs. You have Meta, which is basically Facebook. They announced that they're going to be eliminating 11,000 jobs, which is over 13% of its entire workforce. And then, of course, you have companies like Twitter, Lyft that have already announced thousands of layoffs as well. So we're seeing the layoffs really start to increase at this point. So this is essentially the early stages of this economic recession. And once we finally hit this full-blown economic recession, that's going to be what I refer to as phase 3 of this housing correction. Because as the Fed continues to fight inflation and they keep hiking interest rates, that's going to cause less consumer spending taking place across the nation, which hurts companies' revenues and bottom lines, which means there's going to be more forced layoffs, there's going to be more reduction of hours. All of that takes more buyers out of the housing market. Not only that, but you see more forced sellers on the market, which as people are forced to sell their house, that's more additional supply on the market, which means more downward pressure on house prices. So all that to say that we're finally starting to see house prices decline again, and I do believe it's going to continue from this point on. I think we have a long road ahead of us before we finally reach the bottom of this housing market correction. But if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know your thoughts or questions in the comments below, and I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, you're definitely going to want to check out one of these two videos over here. And with that said, I'll see you guys on the next one.